The shocking truth is that most retail traders are not beaten by institutions, algorithms, news, volatility, or even manipulation. They are beaten by a simple coin toss. Yes, a 50-50 coin toss with a 1-to-1 risk-to-reward ratio quietly outperforms the majority of real human traders who spend years studying charts, indicators, patterns, psychology, and strategies. And that sounds impossible until you look closely at how the game of trading actually destroys people from the inside out. You hear experts talk about risk management, discipline, trading psychology, and staying consistent, but no one talks about the brutal reality that most traders perform worse than pure randomness, not equal to randomness. Worse. And once you understand why, you'll never look at trading the same way again. A coin toss doesn't get emotional, doesn't get greedy, doesn't fear missing out, doesn't overtrade after a win, doesn't shrink after a loss, doesn't move its stop loss, doesn't cancel a take profit, doesn't skip a setup, doesn't hesitate, doesn't get influenced by YouTube, doesn't get stressed by prop firm challenges, doesn't get shaken by a drawdown, and doesn't chase revenge trades after one bad decision ruins a whole week. A coin doesn't panic. A coin doesn't think. A coin doesn't get tired. And ironically, that is why the coin beats 80% of retail traders who believe they are being rational, strategic, and analytical. The coin has one thing going for it. It doesn't have the human brain attached to it. A human trader starts strong for a few trades, maybe follows rules for a week, maybe holds discipline for a month, but eventually emotions break the structure from the inside. A coin toss strategy with 1-to-1 risk stays consistent forever. Humans don't. And once you understand that consistency beats intelligence in trading, you begin to understand why simple edges outperform complex intelligence. People believe they are fighting banks, hedge funds, and high-frequency algorithms, but the real opponent is their own psychological instability. The real opponent is their inability to repeat the same behavior the same way under stress. The real opponent is the internal voice that says, "This time will be different," right before breaking the rule that protects the account. Imagine flipping a coin. Heads you win 1 unit, tails you lose 1 unit. Now imagine doing that for 1,000 flips. You will move up and down, have streaks, have drawdowns, have explosive runs, and still end somewhere near break even. But in that simple random system, the stability of execution is perfect. No emotional deviation, no inconsistency, no stupidity, no hesitation, no self-sabotage. Now imagine a retail trader doing the same thing. He starts with a rule that says risk 1% and aim for 1%. But on trade 11, he widens the stop loss. On trade 17, he closes early because he panicked. On trade 23, he doubles lot size after revenge. On trade 30, he enters without confirmation. On trade 44, he takes a sure shot with 4 times risk because a YouTuber posted a magical setup. The trader didn't lose because of the market. He lost because he couldn't behave like a simple coin. The coin's strength is consistency. The trader's weakness is inconsistency. And that is why the coin wins. The most dangerous illusion in trading is believing that analysis is what makes you profitable. If that were true, every engineer, mathematician, MBA graduate, finance student, and quant wannabe would be rich already. They know statistics. They know probability. They know models. They know how to calculate risk. But when they enter the market, they break down like everyone else because trading is not an intelligence problem. Trading is a behavior problem. The coin toss doesn't think. The coin toss doesn't know support or resistance. The coin toss doesn't know trend lines. The coin toss doesn't know market structure. Yet the coin toss outperforms 80% of retail traders because 80% of retail traders don't follow rules consistently. They don't hold discipline under pressure. They don't behave logically when losses pile up. They don't maintain emotional neutrality. A machine can do it. A coin can do it. A computer can do it. But humans? They fail. The secret that professional traders understand is not that one-to-one risk is mathematically superior to other ratios. The secret is that one-to-one risk keeps you emotionally stable. The stability is the edge. People underestimate the psychological violence of trading. They think they can handle losing streaks because logically, they know losses are part of the game. But logic disappears when real money burns. When you hit your fourth loss in a row, logic begins to shake. When you hit your sixth loss, you begin to doubt the system. When you hit your eighth loss, your brain switches into survival mode. You break rules without realizing it. You chase wins. You avoid setups because the pain of losing is stronger than the desire to follow rules. That is why high risk to reward ratios break retail traders psychologically. They require long streaks of discipline through long streaks of losses. But a simple one-to-one model reduces emotional violence, reducing the mental fatigue that usually destroys people. Most traders don't fail because they lack knowledge. They fail because they are mentally exhausted. They fail because every loss feels like an attack on their identity. They fail because they link money to ego. They fail because every losing streak feels like a sign that they are incompetent. A coin doesn't have ego. A coin doesn't care. A coin toss stays neutral forever. And neutrality is the strongest psychological state in trading. The problem with retail traders is that neutrality is impossible for them. Humans get excited after wins. Humans get scared after losses. Humans get exaggerated confidence after a streak. Humans get insecurity after a drawdown. Humans alter decisions based on emotion. A coin doesn't, and that's why it wins. You can place a coin toss strategy on a chart and simply enter long for heads, short for tails, risk 1%, aim for 1%, and over hundreds of trades the performance will statistically outperform the majority of retail traders who suffer psychological distortions. People hate hearing this because it exposes the brutal truth that complexity doesn't save you. Discipline saves you. A retail trader loses because they create patterns that don't exist. They imagine certainty where there is none. They believe they can outsmart probability. They think a single trade defines success. They treat each position emotionally instead of mathematically. If the coin takes a loss, the coin continues. If the trader takes a loss, he questions everything. A one-to-one coin toss strategy teaches the most important lesson in trading. Consistency is more powerful than prediction. You can't predict. You can only manage. You can only control behavior. You can only execute rules. You can't control the candle. You can't control the trend. You can't control the spike. You can't control liquidity hunts. You can't control news. But you can control your behavior. And yet, the thing traders control the most is the thing they fail at the most. Humans believe they are logical creatures. They are not. They are emotional creatures who use logic only to justify decisions made by emotion. The advantage of the coin toss is the elimination of emotional interference. Imagine trading without fear. Imagine trading without greed. Imagine trading without hesitation. Imagine trading without doubt. You would win. The market doesn't require genius. The market requires neutrality. A one-to-one coin toss is neutral forever. Most retail traders can only maintain neutrality for a few trades before emotion hijacks the system. Now imagine what happens when a trader applies a simple rule with one-to-one risk. They stop chasing massive moves. They stop expecting miracles. They stop hoping for 5-to-1 home runs. They stop holding trades too long. They stop blowing accounts with oversized targets. They start thinking like a casino. They begin seeing the game as a repeated probability event. They begin focusing on execution, not prediction. And that shift is everything. One-to-one risk is the closest thing to emotional freedom in trading. It allows you to detach your identity from each trade. It allows you to maintain flow. It allows you to stay consistent. It allows you to avoid the emotional torture of long losing streaks created by larger risk-to-reward strategies. A coin doesn't feel torture. A coin doesn't fear streaks. But humans do. And that is why one-to-one risk works for humans, while larger ratios work only for machines. Human psychology is deeply flawed for trading. We don't like small wins. We love big wins. We don't like small losses. We hate big losses. But in trading, the correct behavior is the opposite. You must take small wins repeatedly. You must accept small losses repeatedly. You must stay indifferent, consistent, repetitive, unemotional. But retail traders can't do that. They aim for huge targets because they want excitement. They hate taking small wins because it feels insignificant. But the market doesn't reward excitement. The market rewards repetition. Casinos win because of repetition. Quant firms win because of repetition. Algorithms win because of repetition. The coin toss wins because of repetition. Retail traders lose because they cannot repeat correct behavior long enough to see results. The deeper truth is that a coin toss strategy exposes the biggest weakness in trading. Predictability doesn't matter if your behavior is unstable. You can predict the market with high accuracy and still lose money if your behavior breaks under pressure. You can be wrong half the time and still win if your behavior is consistent. The coin toss is wrong half the time but stays consistent. Therefore, it wins. The trader is wrong half the time but changes behavior. Therefore, he loses. The market punishes inconsistency more than it punishes bad analysis. It punishes hesitation. It punishes fear. It punishes greed. It punishes emotional decision-making. It punishes rule-breaking. And the coin avoids all of these by default. The majority of retail traders fail not because they cannot learn strategies, but because they cannot unlearn emotional habits. You need to unlearn impulsiveness, unlearn excitement, unlearn fear of loss, unlearn attachment to outcome, unlearn the instinct to control what cannot be controlled. A coin toss teaches detachment. It teaches execution without expectation. It teaches the emotional neutrality the market demands. Once traders understand this, the game becomes simpler, calmer, more mechanical, and more profitable. The reason the one-to-one coin toss strategy humiliates most retail traders is because retail traders add unnecessary complexity to something that is already brutally difficult. The market is a psychological battlefield, yet most people show up with an emotional system that collapses under pressure. They overthink entries. They obsess about confirmation. They chase the perfect setup. They wait for indicators to align like planets. They spend hours watching YouTube videos hoping someone will reveal a magical strategy. Meanwhile, the coin toss doesn't care. It doesn't wait. It doesn't believe it knows the future. It doesn't look for certainty. It simply executes. And in trading, execution is everything. A strategy is only as good as the trader executing it. A perfect strategy executed poorly becomes a losing strategy, and a mediocre strategy executed flawlessly becomes a winning one. The coin executes flawlessly every time. Humans don't. When you watch retail traders live, their biggest enemy is not the chart. It's their emotional instability. They think they are following rules, but they are constantly negotiating with their emotions. A small retracement becomes a threat. A candle wick becomes fear. A losing streak becomes identity crisis. A win becomes overconfidence. A break-even becomes frustration. Every tiny movement of the market creates internal chaos that destroys decision-making. The coin toss never faces this storm. That's why randomness outperforms overthinking. That's why simplicity outperforms complexity. That's why neutrality outperforms analysis. Professional traders understand the importance of emotional distance. They don't trust their feelings. They don't trust their instincts. They don't trust their excitement. They trust rules. They trust data. They trust risk. They trust repeatability. They trust the long-term outcome. A coin toss mirrors this mindset. It doesn't care about the result of a single trade. It only cares that the rules are applied repeatedly. Humans want each trade to feel meaningful. They want to feel correct. They want to feel smart. They want to feel like they predicted something. This emotional need for correctness destroys traders because it makes them fearful of loss and greedy for validation. A one-to-one coin toss strategy is brutally honest. It exposes every flaw inside the human mind. It shows you that you don't need high accuracy. It shows you that you don't need prediction. It shows you that the outcome of a single trade is meaningless. It shows you that neutrality is more powerful than intelligence. It shows you that consistency beats talent. It shows you that the real challenge in trading is your ability to behave like a machine. And that is the hardest thing in the world for a human to do. When you observe retail traders long enough, you notice a pattern. After a win, they get reckless. After a loss, they get fearful. After 2 losses, they hesitate. After 3 losses, they freeze. After 4 losses, they doubt the strategy. After 5 losses, they change the strategy. After 6 losses, they destroy the account with revenge trading. The coin toss doesn't go through this emotional roller coaster. It simply continues. Humans can't, and that's why humans lose. The one-to-one structure keeps the trader in the emotional middle zone. It's small enough to be achieved frequently, reducing emotional stress. It's not large enough to require long streaks of pain. It keeps losses manageable and wins achievable. It keeps the traders psychologically stable. High risk to reward ratios create emotional torture. They create long waiting periods. They create long drawdowns. They create mental exhaustion. Humans don't thrive under emotional torture. Machines do. Coins do. Humans don't. The market rewards emotional resilience. The market rewards neutrality. The market rewards rule-based behavior. A coin toss has all of these qualities built in. That's why it performs so well compared to the average retail trader. The coin has no expectations. It has no fear. It has no greed. It has no bias. It doesn't get tilted. It doesn't get euphoric. It doesn't get depressed. It doesn't react. It just executes the rule. And if you think about it, the coin toss is the purest form of a trading robot. It removes the weakest link. Human emotion. People hate accepting this truth because it means everything they believe about trading is wrong. They believe success comes from knowledge. They believe success comes from prediction. They believe success comes from strategy, but success comes from consistency. And consistency comes from emotional control. A coin toss has perfect emotional control because it has no emotions. But humans? They become unstable at the first sign of uncertainty. The market is designed to exploit emotional instability. Small drops create panic. Small rallies create greed. Noise looks like signals. Signals look like noise. The trader overreacts. The market punishes. The trader makes impulsive choices. The market punishes again. The trader hesitates. The market punishes hesitation. The trader widens the stop. The market hits it anyway. If the trader narrows the stop, the market hits it too. But the coin toss does not fear the punishment because it doesn't interpret anything as punishment. It interprets nothing at all. It simply executes the next flip. This is why a coin-based model stands stronger than a human mind in a probabilistic environment. Another reason the coin toss beats retail traders is because most traders take uneven risk. A trader will follow one-to-one risk for 3 trades, then risk 5% on a special setup. A coin always risks the same. A trader will risk small on a valid setup and risk big on an emotional one. The coin never does this. The trader will hold losers longer than winners. The coin never does this. The trader will exit winners early and hold losers, hoping they reverse. The coin never does this. The trader sabotages himself. The coin is immune to sabotage. Imagine a scenario where two traders trade the exact same strategy. One is emotionally stable, the other is emotionally reactive. The stable trader wins. The reactive one loses, even though the entries are the same. This reveals the most terrifying truth in trading. The execution matters more than the strategy. A coin toss has flawless execution. A human trader has deeply flawed execution. That's why randomness wins. Not because randomness is good, but because humans are that bad at consistency. The one-to-one coin toss method also works because it creates an infinite sample size. You can take hundreds of trades without emotional destruction. But when traders use large targets, like 3-to-1 or 5-to-1, they take fewer trades, and each trade carries too much emotional weight. When each trade becomes emotionally heavy, the trader begins to panic. When the trader panics, he changes rules. When he changes rules, he breaks the strategy. When he breaks the strategy, the account breaks too. One-to-one eliminates emotional weight. It makes trading boring. And boring is profitable. Exciting is destructive. Casinos are boring. Quant funds are boring. The coin toss is boring. Retail trading is exciting. And excitement is a financial killer. Retail traders also lose because they chase home run trades. They want the glory. They want the huge winner. They want the jackpot feeling. They want the emotional high. But the market rewards repetition, not home runs. It rewards discipline, not excitement. A small consistent system beats a large inconsistent one every time. A coin toss gives you a realistic view of what trading actually is. Small, repeated, emotionally neutral bets placed over long periods. Retail traders want magic. They want shortcuts. They want instant results. That mindset destroys them. The one-to-one structure is sustainable. A trader can take hundreds of trades. They can survive drawdowns. They can maintain discipline. They can bounce back quickly. They can stay in the game long enough for probability to work. High risk to reward ratios kick you out of the game emotionally before the math can even save you. But a coin toss never gets kicked out emotionally. That's why the coin survives longer. And in trading, survival is the real game. Another overlooked reason the coin toss beats most traders is because traders constantly change systems. They jump from strategy to strategy. They hop indicators. They reinvent risk plans. They listen to new gurus weekly. A coin toss never changes. It doesn't care about environment. It doesn't care about volatility. It doesn't care about market type. It doesn't care about structure. The trader who sticks to a rule always outperforms the trader who reinvented their plan 20 times in 1 month. And most retail traders reinvent their plan continuously, destroying the statistical edge of any strategy they touch. The coin toss also exposes the illusion of accuracy. Most traders think accuracy is the key to profitability, but trading is not about being right. It is about managing outcomes. A coin toss is only right half the time, yet it can still beat the majority of traders because traders take inconsistent trades with inconsistent risk, while the coin acts like a disciplined robot. Human accuracy might be higher than 50%, but execution quality is far lower. Execution beats prediction, and the coin's execution score is perfect. A terrifying realization comes when you simulate a coin toss system versus real traders. The coin toss line slowly fluctuates around break-even with mild drawdowns. Real human traders fluctuate wildly, usually trending downward due to compounding emotional mistakes. The coin doesn't self-destruct. Humans do. And that difference alone makes the coin statistically superior. The coin toss strategy also reveals why so many retail traders live in permanent frustration. They expect the market to reward intelligence, insight, accuracy, and hard work. But the market rewards only one thing: discipline. And discipline is emotionally exhausting for humans because it requires you to override your instincts, suppress your impulses, ignore your emotions, and operate like a machine in an environment designed to trigger every survival mechanism you have. A coin has no survival mechanism. A coin has no instincts. A coin does not care if the next flip is a win or a loss. Humans care deeply. Humans panic. Humans freeze. Humans doubt. Humans attach meaning to random events. Humans feel humiliation after a loss and superiority after a win. Humans have egos. Humans fear losing money. Humans fear missing out. Humans crave validation. And all of these emotions drag them into behaviors that sabotage their trades. That is why the coin wins. Not because the coin is smart, but because the human brain is inappropriate for a probabilistic environment like trading. In the real world, your instincts keep you alive. In the market, your instincts destroy you. Your brain evolved to detect danger, avoid risk, and secure rewards quickly. The market punishes all three impulses. When price drops and your brain screams danger, the correct action may be to do nothing. When price rises and your brain screams, take the win now, the correct action may be to stay in the trade. When your brain sees a big move forming and screams take the trade before you miss it, the correct action is often to wait for confirmation or skip it entirely. Trading requires a complete inversion of natural behavior. Humans struggle with inversion. The coin toss has no behaviors to invert. That's why randomness performs better than instinct. The one-to-one coin toss model is the simplest mental discipline trainer in existence. If you can follow a coin flip for 100 trades without deviation, you prove that you have the emotional neutrality required to trade. Most traders cannot even make it through 10 flips without trying to outsmart randomness. They start noticing patterns in randomness, hoping to predict the next outcome. They guess based on streaks. They get excited by small wins. They get annoyed by small losses. They change risk amounts. They skip flips. They tilt after a losing run. They start interfering. In other words, they behave like retail traders. And that is the whole point. Even when the system is random, the trader is not. The trader injects emotion into the process, and emotion destroys the system. Meanwhile, the coin stays pure. The purity is the edge. This is why casinos win reliably. A casino doesn't care if a gambler wins a single round or even 10 rounds in a row. The casino has an edge built into consistency and repetition. It doesn't deviate. It doesn't tilt. It doesn't get emotional when it loses. It stays disciplined through millions of outcomes. A coin toss system mirrors this structure. Retail traders, however, operate like gamblers. They get emotional. They bet more after wins. They bet less after losses. They take random risks. They chase excitement. They want the thrill. They want the dopamine. But dopamine is the enemy of discipline. Every dopamine spike leads to emotional volatility. Every emotional spike leads to inconsistent execution. And inconsistent execution destroys any edge you might have, even if that edge is simple fairness like a coin toss. The market is a psychological pressure cooker. Every candle tests your identity. Every loss feels personal. Every reversal feels like betrayal. Every stop-loss hit feels like humiliation. Every missed move feels like stupidity. Every drawdown feels like failure. And the brain processes all of this as threats. When the brain senses threats, it activates survival mode, which is disastrous in trading. Survival mode amplifies fear, suppresses logic, increases impulsivity, and narrows focus. That is why traders break rules they logically know they should follow. That is why traders sabotage themselves. That is why traders become inconsistent. And that is why a coin toss strategy, with its absence of emotional processing, outperforms a trader who is emotionally reacting to every shift. Another reason the coin toss beats retail traders is because most traders don't even realize they are inconsistent. They think they follow rules, but they only follow rules when they feel comfortable. They follow rules when the market is calm. They follow rules when they just want to trade. They follow rules when they are confident. But the moment discomfort appears, rules vanish. The moment a trade goes slightly against them, rules adjust. The moment fear spikes, rules break. The moment greed spikes, rules stretch. This invisible inconsistency compounds silently until the account collapses. The coin toss has zero variance in behavior. It maintains perfect procedural integrity, and integrity produces results. The one-to-one structure also highlights the importance of expectancy. The expectancy of a coin toss system is near zero, but the variance is controlled. Meanwhile, the expectancy of a retail trader with emotional inconsistency is negative. Even if the trader has a strategy with positive expectancy, their deviation from rules turns that positive expectancy into a negative one. You cannot profit from a system you refuse to execute consistently. A coin doesn't refuse. It obeys the rule 100% of the time. The more you look at the coin toss strategy, the more it reveals the central truth of trading. The game is not about beating the market. It is about not beating yourself. Most traders are not competing against institutions. They are competing against their own impulses. They are losing battles against overconfidence, fear, hesitation, greed, revenge, frustration, boredom, impatience, and the desire for certainty. A coin has none of these. This neutrality is what turns randomness into an edge compared to emotional inconsistency. Neutrality is the holy grail of trading, not signals, not indicators, not strategies, not patterns. Neutrality is the reason algorithmic trading dominates. Neutrality is the reason quant funds crush discretionary retail traders. Neutrality is the reason systematic approaches consistently outperform intuitive ones. And a coin toss is the purest demonstration of neutrality. A trader with neutrality can outperform his own emotional tendencies. But retail traders rarely reach neutrality because their minds are constantly under stress. The stress comes from outcome attachment. Retail traders attach meaning to each trade. They treat wins as proof of intelligence. They treat losses as proof of incompetence. They treat break-evens as wasted effort. They treat missed entries as personal mistakes. They treat market movement as judgment. This emotional attachment transforms trading into psychological warfare. A coin toss has no attachment. That detachment is power. One-to-one risk reinforces detachment. Each trade is just one unit versus one unit. Nothing too big, nothing too dramatic, nothing too emotional. When traders adopt realistic targets, their emotional volatility shrinks. They stop holding trades forever hoping for massive wins. They stop resisting small losses. They stop expecting miracles. They stop chasing perfection. They start seeing the market for what it is, a long-term probability engine. And once they see this, they understand why the coin toss wins. The coin toss plays the long-term game flawlessly. Retail traders play the emotional game, and the emotional game always loses. The coin toss also reveals how traders self-sabotage through inconsistency in position sizing. Retail traders increase lot size after winning streaks, thinking they are invincible. Then a normal loss wipes out 5 wins. Other traders decrease size after losses, sabotaging the expectancy of the system. Others randomly increase size out of desperation. Others keep adding size to losers, which is financial suicide. A coin toss has fixed size always. That stability over time keeps the equity curve controlled. Human instability destroys the equity curve through uneven pressure. The hardest pill to swallow is that trading success is less about intelligence and more about self-control. A coin has perfect self-control. A trader rarely does. When you remove emotion, remove flexibility, remove deviation, and remove impulse, success becomes a matter of time. But when you operate with emotional reactivity, you sabotage even the best potential system. Retail traders often think they lose because they haven't found the right strategy, but they lose because they haven't found the right version of themselves. They want better indicators, but they need better emotional software. They want perfect timing, but they need perfect discipline. They want certainty, but they need neutrality. They want magic, but they need repetition. They want prediction, but they need consistency. And when you compare all of this to the coin toss, it becomes painfully obvious why the coin toss outperforms 80% of traders. The coin already has the qualities humans fail to develop. And this is the final truth. If you can behave like a coin, neutral, unemotional, repetitive, rule-based, consistent, you will beat the majority of traders. The coin is not profitable because it's brilliant. The coin is profitable because it doesn't self-destruct. Humans self-destruct constantly. They intervene. They modify. They override. They panic. They hope. They fear. They adjust. They break. But the coin does none of this. The coin shows you the essence of trading. Remove yourself, and you remove the biggest problem. If you remove emotion, trading becomes simple. If you remove prediction, trading becomes calm. If you remove inconsistency, trading becomes profitable. The coin toss represents all three removals. It strips trading down to its raw truth. The market rewards those who can repeat correct behavior without emotional interference. Therefore, the reason a one-to-one coin toss strategy beats 80% of retail traders is not because the coin is good. It's because the average trader is so inconsistent, so reactive, so emotionally unstable, and so self-sabotaging that even pure randomness, when paired with perfect discipline, becomes superior. And until a trader learns to behave with the cold neutrality of a coin flip, executing a plan without hesitation, fear, greed, or emotional attachment, he will always lose to systems far simpler than he imagines. Systems that don't predict, don't analyze, don't think, and most importantly, don't get in their own way. Trading success is not about beating the market. It is about beating the emotional chaos within. The coin toss never faces that chaos. That is its true edge, and that is why it quietly outperforms most traders who walk into the market with all the knowledge in the world, but none of the emotional control required to use it.